We made it to the end of the semester. Welcome back to Principles of Accounting 2. Happy to have you with us as we finish up the fall 2023 semester. Already thinking in 24. So we have experienced the past 7 weeks, roughly, Principles of Accounting 2. We walked through a lot of work over the past 6 weeks of the course, 7 weeks of the course. And overall, I would say that things went pretty well. The majority of the class is doing very, very well. There are a few students who not do the work. And, when you don't do the work, it doesn't go well. Yeah. That's why it's important to do the work. Do the work, you pass. It's that simple. We talked about that at the very beginning of the course. And I'm very pleased to report that the majority of the students in this class are passing, which is fantastic. It makes me feel good. That means that we're doing the right things. That means that we're in good shape. We are last week of the class. So just before we jump into the chapter, I want to call your attention to the classroom. Week 7, last week of the course, what do we have to do? We're going to go through chapter 26 here in a second. We have a couple things we need to complete. Chapter 26 quiz. We have a report, a written report, okay? Word document. This Word document report is based off of your experience with QuickBooks over the past few weeks. As you know, you have been completing LinkedIn Learning certificates using QuickBooks. Based off of that experience and what you've learned about the software, and hopefully you'll learn a little bit more by going to the website and et cetera, I would like you to construct a report about 800 to 1,000 words, so not terribly long, okay? A couple pages. APA format where applicable. I want you to construct a report about QuickBooks. I want you to include these 10 sections in your report. Introduction, overview, practical experience, key functions and tools, challenges, benefits and advantages, a case study or example, future application and conclusion. All of you probably won't use QuickBooks in the future. Okay? Some of you might. If you start your own business, you go into another business where you're a manager, etc. You probably use QuickBooks or something like it. So number 7 might be, or number 8 might be a bit of a challenge. I want you to really think about this, okay? The idea behind this report is I want you to think about the tools that you're going to be using as a manager in the future, like QuickBooks, which will help you in your position. That's the ultimate reason behind this assignment. We'll jump more into this after today's lecture, but I just wanted to preface what is to be done by Sunday night. This coming Sunday, is the last day of the course. So having said that, all of your remaining work, including Chapter 26 quiz and the QuickBooks report, are due on Sunday night. I cannot accept any late work beyond this Sunday night. That is a university policy. Okay? Not accept any work past this Sunday night. I make the rules. Okay? So please make sure that if you have anything due, complete by Sunday night. Please. And of course, I'll remind you along the way throughout the next few days, but I just wanted you to be aware of this policy, that we follow it very strictly. This includes the report and the quiz for this week, in addition to anything that's past due. So please make sure all of that work is due by Sunday night. The only exception, of course, is the final exam, which we'll talk about today as well. So without further ado, let's jump into our lecture on capital budgeting and investments. And I will do my absolute best to make it as relatable as possible, just like I normally do, to help you to understand the information. So, in business, we make investments to grow the business. Okay? And when we make investments to grow the business, we need to budget for those investments. We need to plan for those future investments. And the way we do that is by creating what we call a capital budget. You may recall the term capital budget when we talked about the master budgeting process. I think that was a few weeks ago. It was some time ago, maybe 2 weeks ago, something like that. Right? We talked about the master budgeting process. When we went through the master budgeting process, we briefly touched on capital budgeting. The idea behind capital budgeting is that the business is setting aside additional capital in order to purchase property, plant, and equipment to grow the business. Okay? Capital budgeting also involves selling those things. The future. Yeah, it's the future planning. That's the idea behind budgeting. For capital budgeting, we're looking at property, plant, and equipment, and purchasing new property, plant, and equipment, or selling property, plant, and equipment. So the way it works is through this short process. Manager submits a proposal to purchase or sell property, plant, and equipment. The capital budgeting committee gets together and evaluates this proposal and then recommends to approve or reject the proposal. And then the board of directors then makes the ultimate approval for the year, this budget. Yeah. So it's a three-step process when it comes to capital budgeting. A couple of decisions need to be made when it comes to capital budgeting. The reason why these decisions need to be made is because capital budgeting involves risk. Risk is that there's some uncertainty that a purchase or sale of property, plant, and equipment might fall through, might have a high interest rate, or some factor thereof. That's why we go through the process. So the decision-making process involves these four things. Understand the risk. Number one is the outcome of the decision is uncertain. Something might happen to the asset that you're trying to purchase or sell. It's uncertainty. The buyer might decide to pull out of the deal, or the bank might decide not to finance the purchase. Those are uncertain outcomes that may or may not happen. So that's part of the risk. The second part of the risk in property, plant, and equipment selling or buying is that it requires a lot of money. Okay? Buy a building, you're talking millions of dollars. Buy equipment, that could also be hundreds of thousands. Etc. Right? A lot of money. So there's risk, right? The money usually means a lot of interest. In most cases. Number three, investment involves a long-term commitment. The building's going to be there for a long time. It's going to fall apart. That's what happens with age. So we try to fix it. Long-term commitment. The machinery is going to last several years. Long-term commitment. Yeah. When we're talking about property, plant, and equipment, it's long-term. Okay. So that's a part of the risk. What happens if we decide that we don't need it anymore, or it breaks too much, or whatever? It's long term, so we got to figure those things out. Number four, and this is probably the most risky part of the decision-making process, is the decision to purchase or sell property, plant, and equipment may be difficult or impossible to reverse. So what happens, right? You bought this $1 million piece of machinery to expand your business, and then, a year into it, you're like, this thing doesn't do what I need it to. Now you can't sell it because it's a customized piece of machinery. Nobody wants to buy it. Difficult to reverse, you see. Or you commit to buying a building and your funding falls through. The bank doesn't care because you already signed. So that makes it difficult to reverse that decision. You need to be very careful when it comes to purchasing property, plant, and equipment because of those reasons. Where does the money come from? Purchase the property, plant, and equipment. Well, it usually comes from either taking out a loan, issuing stock, issuing bonds, maybe both, maybe raising the cash from the original owners to purchase the property, plant, and equipment. That's where the cash comes from into the business. The cash flows out of the business for that initial investment to purchase it, right? So to acquire it, cash flows out of the business to buy it. Then we start using property, plant, and equipment to generate sales. Using the machine to create the goods that I'm selling to my customers. So cash is coming in from the sale of the goods that I'm making with my equipment. But also, cash is flowing out of the business because I'm using the equipment. The electricity to use it, the maintenance, the depreciation, expenses going out. You see? Use equipment that we're using to generate sales. Over time, I decide, you know what? This machine has reached the end of its useful life, or I no longer need it, or I no longer want it, so I'm going to sell it, dispose of it. Earn what's called salvage value. That's what it's worth at the end of its useful life. Or sell it. I get a little cash coming in when I get rid of it. So this gives you an idea of what happens with the cash when we purchase property, plant, and equipment, use it, and then dispose of it. So before I decide to purchase property, plant, and equipment, I need to think about what we call the payback period. This tells us how quickly, how much time will pass as I recover the initial investment amount, the payback period. That's where the name comes from. How long does it take for me to regain initial investment as I use the machine I purchased, right? So here's how it's calculated. We take the initial investment amount divided by the annual net cash flows. Remember, annual net cash flows is based off of the expected cash coming in minus cash going out of business operations in a particular year. Cash coming in minus cash going out equals the net cash flow. So, initial investment divided by that annual net cash flow equals the payback period. This tells you how many years is it going to take for me to regain the initial investment amount. Of course, the shorter amount of time, the better. I buy a piece of machinery based off of how quickly I can make that money back. Yeah, that's the idea. So I'm going to walk through a couple of different examples with you, help you to understand how the payback period works. We have an example. Our company, Fast Track. You might recall our company machine sells components that go into engines. Fast Track. We are going to purchase a piece of machinery, purchase and install a piece of machinery that costs $16,000. It has a useful life of 8 years and a salvage value of 0. Annual net cash flows are equal. What this means is that every single year our net cash flows are the same. Maybe the company works with a contractor and this is the only job that they do. Okay, that's when your net cash flows will be equal. The same amount of cash coming in minus the same amount of cash going out equals the same net cash flow. Okay. So, in this example, expected sales per year are 1,000 units. The sales price is $30 per unit. Okay, that's $30,000. We have the same expenses every year. We have materials, labor, and overhead of $16,500. Depreciation of the machine of $2,000. And we have selling general administrative expenses of $9,500. You'll notice that depreciation is not cash based. Okay. The reason why is because we don't pay cash for depreciation. Depreciation is representative of the value of the machine going down every year. You see? There's no cash. There's no cash involved there. We're not paying depreciation expense. So our cash flows every year is $16,500 materials, labor, and overhead. and the selling general administrative expenses, $9,500. So we take our sales minus our expenses, we get a net cash flow of $4,000 per year in this example. So we take the initial investment of $16,000 divided by the $4,000 annual net cash flows, gives us 4 years. 4 years represents the amount of time it will take for us to be paid back for our initial investment. See, that's how that works. Now, what happens when the business does not have equal cash flows every year? In most businesses, the cash flow fluctuates from year to year. It's normal. It's normal. That's the way it's supposed to work. Your net cash flows are usually not going to be the same every year, unless you're working on one contract and that's it. Here we have an example. Same criteria. Machine costs $16,000, an 8-year useful life, $0 salvage value. Right? Our earlier example, the payback period was 4 years because we had equal cash flows. Now we have unequal cash flows, and this is what it looks like. Initial investment, we bought the machine for $16,000, so minus $16,000. In year 1, our net cash flows were $2,000. Year 2 was $4,000. Year 3 was $4,000. Year 4 was $4,000. Year 5 was $4,000. So almost equal cash flows, but year 1 was a little shaky. Okay. Maybe we bought the piece of machinery in halfway through the year. Okay. What this might tell us. So what we do is we need to find the point where the cumulative net cash flows equal 0. That's when we know we've been paid back for the initial investment, right? So initial investment was minus $16,000. I add each year of cash flows until my cumulative net cash flow equals 0. I can see, based off of this chart, that the payback period is 4.5 years. How do I know? At the end of year 4, my cumulative net cash flow was minus $2,000. At the end of year 5, my cumulative net cash flow is expected to be positive $2,000. Now that clearly tells me that my payback period reached 0 happened between years 4 and 5. If I mathematically figured out, I know that it happened at 4.5 years. So in June of year 4. That's how it works on uneven or unequal cash flow. You will probably experience a couple of different examples with this uneven cash flows where the net cash flows are not the same every year. It won't be 4, it might be 4, then 6, then 2, then 1, help you to find where it reaches 0. That's what ultimately you're looking for, the cumulative net cash flow. So as a manager, the reason why I use the payback period is because it uses cash flow. Right? It gives me an idea of when I'll be able to pay it back. It's pretty easy to compute. It's like I'm projecting my cash flows, trying to figure out what exactly I'll be able to get my initial investment back. That's the idea behind it. Very simple, very easy to use. But here's the thing. Once I've got my initial investment back, it doesn't consider anything thereafter, because we would expect everything thereafter would be positive, would be a good thing for the business. But we don't look at that. We're only concerned with when we make our initial investment back. And the other thing is that it ignores the time value of money, which means that we're ignoring things like interest rates, and time value money back. Yeah. So some good things and bad things with using the payback period. I personally like it because it's easy. It's simple to understand. So that's the payback period. Now I want to talk to you about what we call the accounting rate of return. Accounting rate of return, the idea behind it is that it tells us what we call the internal rate of return is. Okay, it says that this is what the business would like to see for rate of return. Remember, rate of return looks at how effective I'm using the machinery to generate revenue, right? So based off of that, we look at what's called the accounting rate of return. It's an investment's annual income divided by the average amount invested into it. That's the accounting rate of return. So first we got to figure out what is average investment. The average investment is the initial investment for the piece of machinery in our example, plus its salvage value divided by 2. Remember, in accounting, to find the average of pretty much anything, it's whatever plus whatever divided by 2. Beginning balance plus ending balance divided by 2. So you find the average. So, this example, initial investment, 16,000 plus salvage value, 0, divided by 2 is 8,000. 16,000 divided by 2 is 8,000. To find the accounting rate of return, we take the annual income divided by the average investment. Based off of our earliest example of even cash flows, the annual income is $2,000. $2,000 annual income divided by the average investment of $8,000 yields us 25%, 0.25. Just multiply by 100, right? So 25% accounting rate of return. You might be asking, well, Dr. B, is that good? Is that bad? What's 25%? What is the... It's important to remember that managers prefer investments with a higher accounting rate of return. Management also sets the required minimum rate of return. So, having said that, 25% is pretty good. Pretty good. We compare it with other alternative investments. When management decides to purchase something like property, plant, and equipment, they don't just look at one piece of machinery or one building. Usually there's a couple of options laid out. Equipment A, B, or C. Building A, B, or C. Okay. The idea here is that management's making a decision between alternative investments. So whichever investment has a higher accounting rate of return is the investment that management will probably go with. That's how that works. So, unfortunately, it's not always the easiest thing to use because accounting rate of return does not consider the time value of money, which looks at things like interest rates. And it does not directly consider the cash flows and the timing of such cash flows, like we did with the payback period. Okay. So the reality is, in most cases, when we make a decision to purchase property, plant, and equipment, we usually look at things like the payback period, the accounting rate of return, and net present value. That's what we're going to talk about next. net present value, the idea behind net present value is we look at what we call the time value of money. We look at that with respect to future cash flows, cash inflows and outflows, to understand the viability of a project. Purchasing property, plant, and equipment. Present value. We call this the time value of money because we look at the future cash inflows and outflows for a future project, like purchasing property, plant, and equipment. $1 is worth less in the future than it is today. $1 is worth less tomorrow than it is today. Can anyone on the call today tell me why that's true? Why would $1 tomorrow be worth less than $1 today? Who can tell me this? Anyone? Feel free to unmute your mic. Let me know why $1 is worth less tomorrow than it is today. I'd like to answer that question. You can also type it in the chat if you feel it. Any thoughts? Why is $1 worth less tomorrow than it is today? What do you think? Why is that true? Happy to hear your answer. What do you think? Now, don't all answer at once. Anything, any thought? Why is $1 tomorrow worth less than $1 today? Think about it. What can I do with $1 today? Come on.
Doesn't it change? Like every day is a worth of $1?
Yeah, that's part of it. Yeah, absolutely. So, Chris, what can you do? What can you do with $1 today that you can't do with $1 tomorrow? Changing the value of the currency, yeah, that's part of it. But what's the rest? What do you think, Christy?
But when you invest $1 today, if the market is like looking good, I guess it'll potentially grow by tomorrow.
Absolutely. So what makes it grow? Think about your bank account. What happens when you put $1 in the bank? You leave it there. What happens to it?
Well, it grows because of the interest rate.
You got it. That's exactly it. It's the interest rate.
Okay.
Yeah, yes, 100%. So, just as Christy explained, when we take $1 today and we invest it, it gains interest. Okay, so therefore, $1 today is worth more than $1 tomorrow. See? Interesting. Well done, Christy. Thank you. So this is why we calculate what we call the net present value. Discounting the future net cash flows from the investment as a required rate of return, subtracting them by the initial amount of the investment, is how we calculate net present value. It's a little bit more complex than that. Okay, a little more complex. The company's required rate of return is what we call the hurdle rate. It's internal. The management decides what this number should be. They do that based off of what they believe that they need in order to generate a positive return off of their investment. Usually anything greater than 0 is good. Okay. I will tell you that calculating things like net present value, future value, is not easy. We have financial calculators that do that for us. Using Excel can do that for you. We have built-in formulas in Excel to calculate net present value. That's how complicated it can get. Okay. What you need to know are things like the interest rate, how long the investment is for, and the amount either being deposited today or the amount that you need in the future. Okay. Those are the pieces of information you plug in, and it'll generate what we call the net present value. So let me show you an example of what this looks like. We have a company is considering $20,000 investment into a new piece of machinery. It is expected to provide us with $10,000 of net cash flows for the next 3 years. The company has a required internal rate of return of 9%. Now, typically, we'll just take out a financial calculator, punch in the following pieces of information. $1,000 investment, $10,000 cash flow, 9% return. My response. Oh, 3 years time. So that's one way of doing it. Very simple. Use a financial calculator. Another way to do it is to use Excel. You'll be able to get the same response. We have a table. Okay. A table also commonly used. We take the present value of 1 at 9%, we trace it downward, and we fill in the pieces of information. $10,000 times 0.9174 is 9,174. 1,000 times 0.8417 is 8417, etc., etc. You see? You'll see that over the 3 years, I got to 25,313. Take the 25,313 for the 3-year time frame minus the initial investment of 20,000 gives me a present value of $5,313. The net present value is greater than 0. Therefore, it makes sense for the company to purchase this piece of machinery. So it works. The idea behind it is that we need to understand what initial investment will be worth at the end of that time frame. Yeah, that's why we do this. So when an asset is expected to be greater than 0, we do the investment typically. So there's a formula to figure this out. Present value of net cash flows minus the initial investment equals the net present value. If it's greater than 0, we accept the offer or the investment. And if it's not, then we don't. Yeah. Of course, yes, there's risk involved because we know that the cash flows aren't always the same. We know that there are other factors of risk, but without consideration of those things, if it's greater than 0, we accept it. If it's not, we do not. That's not present value decision making. A simple. Here is a very helpful thing to consider when it comes to net present value. You can actually use net present value to calculate what we call an annuity. Annuity is a series of cash flows of equal amounts. Okay. Most of us, pay annuities, and some of us receive annuities. This is the same amount of money paid every year. An example of an annuity payment is rent, mortgage, your car payment. Those are called annuity payments. You pay the same amount every single month. Okay. Another way to think of an annuity is in retirement. When you retire, hopefully you retire, and hopefully you collect an annuity of sorts. You collect what we call Social Security, or a 401k, or a combination of both, or a pension, or whatever. We call those annuities. There's a way to figure out how much you need to invest today in order to generate a certain amount of money in the future for every annuity payment. You do that through what we call net present value using annuities. Okay. How it works. Here's the example. The initial investment is $20,000. We expect to have equal net cash flows every year of $10,000. Machine has a $0 salvage value at the end of year 3. We make the initial investment, $20,000. We have the 3 years, $10,000 cash flow times 2.5313, which we found from our table at 9% interest. Which gives us 25,313 minus the initial investment of 20,000 equals 5,313. That's the example when we purchase a piece of machinery. Okay, to find net present value. You can do the same exact type of concept when you're investing retirement. Okay. Your initial investment is the amount that you're putting in today. Net cash flows represent the amounts that you would receive in the future. So net present value is what is the value of that today. So this is one of many examples, so I'll show you a couple of others. So here we have another example. Our company is looking to automate the production process. So we look at net present value to understand the applying annuities assumption if we want to automate. Manufacturer is looking to invest $80,000 in automation. This investment would reduce labor costs by $15,000 per year for 10 years. We use a 10% discount rate and a $0 salvage value to understand this. So, net cash flows is $15,000. That's what we expect to save. At 10%, the present value of the annuity is 6.1446, found on the table, where the number of years is 10 and the interest rate is also 10. That gives us a present value of the net cash flows of $92,169. 6.1446 times the 15,000. minus the initial investment of $80,000 gives us a net present value of $12,169. Based off of this example, it would make sense that the company engages in automation because the net present value is above zero. We have an example where the net present value is unequal cash flows. The initial investment is $15,000. We have years 1, 2, and 3. We have options of project A and project B. We have net present value of 1 at 10%. We multiply the net cash flow times the present value of 1 at 10%, which is interest rate. Find the present value of the net cash flows for each project at each year. Add them all up. Subtract the total from the initial investment to find the net present value. In this example, it would make sense that the company goes with project B because the net present value is higher than it would be in project A. And to mention in year 1 has a greater cash flow. So here we have another example of using net present value when there's a salvage value of the machinery involved. We take the cash flow times the present value of the factor, 10%, and 10%. Take that amount times the net cash flow to find the present value of net cash flows. We then add in the salvage value. The salvage value, you'll notice, is calculated separately. The net cash flow, the salvage value, times that percentage. Add in the total minus the initial investment, net present value 16,024. Of course, that salvage value is additional net cash flow because, as you know, when we sell a piece of machinery and it has salvage value, we receive whatever that salvage value is at the end of the asset's useful life. So on paper, it looks like the net present value is a lot higher. That's just because there's salvage value involved. So you might be faced with making a decision between 3 different possibilities. Option A, B, and C, or 1, 2, and 3. So we do this process called indexing when you have more than one alternative. Okay? So indexing is a way of ranking different alternatives. Okay? So here we have the indexing formula. We take the present value of the net cash flows divided by the initial investment. So for that simple formula, we have 3 different projects, 1, 2, and 3. Present value divided by the initial investment. I got profitability index of 1.2, 1.5, and 0.9 respectively. Obviously, the one I would select would be project 2 because it has a profitability index of 1.5. Second option would be project 1. I probably would not select project 3 because it's below 1. That's how that works. So when you hear the word index, it's a ranking system. Okay. We talked about the accounting rate of return. Now I want to shift gears just a little bit and talk about what we call the internal rate of return. This is I'll say a part of, related to, net present value. The internal rate of return looks at what we call the discount rate rather than the interest rate. And the internal rate of return as a discount rather than a interest rate. What we do is we subtract the initial investment from the total present value rather than add it to, because we consider this to be a discount rate. Okay, so put it in simple terms. It's a two-step process. Step one, compute the present value factor of the investment. To do that, we take the initial investment amount divided by the annual net cash flows. Step two is we identify the discount rate, the internal rate of return, building the present value factor. We do that using a chart, typically. That's how it looks. Step one, compute the present value for the project. So investment divided by net cash flows. This example is 2.4018. Based off of 2.4018 and the amount of time, 3 years, I can then find the percent discount. In this example, 12%. It's a matter of taking whatever the present value factor is, looking at the chart, finding the number of years for the project, in our example, 3 years, going over, and you find the number, the present value factor, you found the percentage. Like a big chart. You have a bunch of years, a bunch of different percentages, and then you have the present value factors listed out. Finding the present value factor for the respective year. That gives you the discount rate percentage. You may have seen these before. Oftentimes they're found what we call annuity tables. So using IRR, internal rate of return, for unequal cash flows. When the internal rate of return is greater than the hurdle rate, remember the hurdle rate is the accounting rate of return. We invest. Yeah, we do it. When the internal rate of return is less than the hurdle rate, accounting rate of return, we do not invest. Very straightforward. Because remember, accounting rate of return is the minimum. This kind of just summarizes the strengths and weaknesses of capital budgeting. Looked at the payback period, accounting rate of return, net present value, and internal rate of return methods. These four methods are the most commonly used in accounting to evaluate the purchase of property, plant, and equipment, and to evaluate potential projects that the company is looking to take on. Very common. Very common. So now that we've talked about those four commonly used methods in capital budgeting, I would like to look at another concept called break even. As you probably know from our discussion, earlier discussions, when it comes to budgeting, look at break even. Break even tells us how many units or sales dollars I need to earn and sell in order to break even, not generate a profit and not generate a loss. The same concept applies in capital budgeting when it comes to identifying how long it will take me to use a piece of machinery, equipment, or whatever I purchased to generate revenue to the point where I've broken even. Here's how long it takes. It's similar to the payback period, not the same. Okay, here we go. Here's an example. Break even in time. How long it takes. I bought a piece of machinery for $12,000. So the initial outlay in cash is $12,000. 10% investment, 5 years. I list out the 5 years. That cash flows are even, 1,100. 10%, 5 years. I find that my present value at the end of the 5th year is $3,541. That's higher than 0. Even I'm looking for 0. Okay. 4, 995 positive. That means I broke even before year 4. 3 was minus 1,805. That tells me I broke even somewhere between years 3 and 4. To figure this out in the exact amount of time, do it like this. We take the cumulative net present value of that year 1,805, year 3. Divide that by the years 4 present value of the net cash flow, 2,800. That gives me the exact amount of time in between years 3 and 4. In this example, would be 3.64 years. Now, of course, the easiest way to do any of these types of calculations, it's Excel. Okay. Excel has built-in formulas for internal rate of return, net present value, the payback period. It has all these amazing formulas built into it. So if you're ever faced with a situation in management, and somebody asks you, your boss comes to ask you, hey, calculate the internal rate of return for this potential investment, you're like, hey, no problem. You break open Excel, you punch in the formulas, you run it out. You can show your boss, and then your boss will be like, oh, that's really impressive that you know how to do that. Just something you should be aware of. All these types of difficult computations, you can usually find those built into Excel. And of course, the internet is full of wonderful calculators you could use, especially when it comes to property, plant, and equipment investments or whatever. So, my friends, is the end of our discussion when it comes to capital budgeting and investing. Any questions, comments, concerns on this chapter before we jump into discussion on the essay and then the final exam? Good. Does that all make sense? Straightforward, clear? Yes. Go okay? Still awake? Thank you, Danielle. We did that. Okay. Right. So, quickly, classroom. Here's what you need to do by Sunday night. Things. One is a quiz. The chapter we just talked about. You'll probably see a couple of calculations you got to do. Be all right. Just follow the examples that we walked through in the PowerPoint, and you'll be all right. And the other thing you got to do is a report. It's a written report. Use Word or something like Word. Write it out, okay? Please no paper or sign. We don't do that. Okay, here's how it looks. Here's the way it works. So you'll type up a report, just like you've hopefully done in previous classes. You'll have your name, you'll have the title of the report, the date, class, etc. Page. And you go into writing the report out. The report needs to have these 10 sections. Okay. It doesn't need to be terribly long. The report is on QuickBooks. Why is it on QuickBooks? Because throughout the past 6 weeks, we've had a couple of LinkedIn Learning certificates. You learned about QuickBooks. QuickBooks is the most commonly used accounting software in the United States and around the world. 85% of businesses on the planet use QuickBooks in one way, shape, or form. Because of that, I found it important for you to tell me what you know about it. This gives you a practical experience of using the software which you've done through your LinkedIn Learning certificates. So here's what I'm looking for. First part's an introduction. Got the report, talking about the importance of QuickBooks today. It's important to learn it. What's involved. Highlighting certain processes and procedures, accuracy, blah, blah, blah. Introduction. The overview of the software is the next part. I want you to talk about its important features, how it's commonly used in accounting today. I also mentioned the different types of software that's available. An online version, the desktop version, etc. Part 3 of the short essay is practical experience. Now, you may not have had the opportunity to work with it hands-on, downloaded it, the trial version, whatever. Some of you might have done. But I want you to talk about your experience. Experience with the LinkedIn Learning certificates, the experience from that perspective. That's practical experience. Step 4 is I want you to talk about the key functions and tools within the software you think are the most important, how they're used. Section 5 of the essay is the challenges that you may have encountered, that you think might exist if you haven't used the software. Section 6 are the benefits and advantages of using the software. Discuss how it saves time, how it's accurate, etc. Section 7 is a case study or an example of specific uses where QuickBooks has played a critical role. If you haven't used the software, then look at a case study. Section 8 of the essay is software application. How you might plan to use it in your future, if at all. How would you plan on using it? If you don't, say that too. How it might be used in your field. Section 9's conclusions. And then the last part of your essay should be references. Try to use APA style where possible. Okay. The report does not have to be long, 800 to 1,000 words. It's not terribly long. Okay. Couple of pages. Should be well structured. I want you to use headings, subheadings, APA style. Yep. That's the report. Any questions on the report that you need to write? You have until Sunday night to do this. Okay. Please make sure it's done by Sunday night. I cannot accept it late. I'm sorry. Just can't. Last day of the semester is on Sunday. Some of you already done it, so thank you. Thank you for those that have already done it. Okay, that's the report. Let me stop this part of the recording and I'll start a new one for the final exam, so please stand by.